So my advice to value investors is to get used to making less.
Charlie has been telling me the same thing the whole time we've known each other. I mean, we get along wonderfully because...
So we are making less.
Yeah, well, but that's because that mostly, I think, is because it's larger.
When we were younger.
But I would argue that there's going to be plenty of opportunities. New things coming along don't take away the opportunities. What gives you opportunities is other people doing dumb things.
Warren Buffett, the financial oracle with a net worth of more than $100 billion, has sounded an earth-shattering alarm, unveiling a looming $1.4 trillion debt-driven storm ready to pummel the U.S. real estate market. This isn't just a financial storm, it's a game-changer with repercussions beyond mere numbers. In this video, we will discuss the $1.4 trillion debt storm highlighted by Warren Buffett and its far-reaching impact on the U.S. real estate market. Don't miss out on the crucial details. This isn't just about finances, it's about the potential reshaping of the American real estate landscape. Warren Buffett's ominous warning demands attention, and understanding its implications is key to facing the storm. Stay tuned to gain insights that could influence your approach to real estate in the foreseeable future. Buffett has recently issued a chilling warning about the real estate market, describing a colossal storm looming on the horizon. This debt-driven tsunami storm is poised to wreak havoc like nothing witnessed before. Yet the current market conditions mirror those of the early 2000s preceding the housing market crash. But why is Warren Buffett deeply concerned? The linchpin in real estate profitability is none other than the interest rate. As these rates ascend, those who once secured loans at favorable rates are now grappling to meet their mortgages, plunging into financial turmoil. It's a challenging time for anyone to navigate, and it is futile to swim against a robust current. So here's where the descent begins. Non-recourse loans are nearing maturity, and the properties they funded have depreciated below their initial purchase prices. It's the perfect storm in the making, laying the groundwork for a potential wave of foreclosures and overwhelming financial hardships. The fallout appears daunting. The struggle is undeniably real, my friends. Unraveling the trends in the real estate market amid this chaos, the UBS Global Real Estate Bubble Index 2023 recently disclosed a notable shift in the real estate landscape, substantiating the warnings. Delving into the data, we're witnessing a decline in housing market imbalances. From mid-2022 to mid-2023, average house prices saw a 5% dip in major cities. Yes, you heard that right, a decrease in prices. Escalating financing costs with mortgage rates tripling since 2021 in most markets have put a dent in house price growth. Annual nominal price growth in the 25 cities analyzed stalled after a robust 10% rise a year ago. Adjusting for inflation, prices are now 5% lower than in mid-2022. Now let's explore individual cities. Frankfurt and Toronto, once high on risk scores, witnessed actual prices plummet by a staggering 15% in the last 4 quarters. High market valuations and shorter mortgage terms have exerted pressure on prices in specific cities. But not all cities are weathering the same storm. Interestingly, inflation acts as a double-edged sword. While it has diminished imbalances due to declining house prices, it hasn't necessarily made housing more affordable. The living space financially feasible for many remains 40% lower than in the pre-pandemic era. The ramifications of this storm won't be confined solely to the real estate industry. Its impacts will spread far and wide, akin to a wildfire on the loose. Regional and community banks are in for a challenging journey, facing losses in the commercial real estate sector. As they feel the crunch, shockwaves will reverberate through the entire economy. Small businesses will grapple to access credit, economic growth will take a hit, and the ripple effects will permeate every corner of our financial world. Now, let's hone in and scrutinize the recent trends in the real estate market, with a primary focus on the perspective of real estate investors. According to recent data, real estate investors are taking a significant step back, purchasing 45% fewer homes compared to the previous year. This decline surpasses the overall drop in home sales, making the most substantial decrease since 2008, except for a brief period when they plummeted by 48%. The market share for investors has dwindled to 16%, a notable drop from its all-time high of 20% in Q1 of 2022. Areas like Phoenix and Las Vegas, which witnessed a booming real estate market during the pandemic, are now experiencing the most significant declines in investor activity. The frenzy triggered by the pandemic, leading to a surge in home buying and rental demand, is now subsiding, making investing in homes less appealing. Investors are shifting their focus towards low-priced and single-family homes. Despite the limited inventory causing a year-over-year decline in purchases within this category, offers from hedge funds have noticeably dwindled, shifting the market from being investor-dominated to more accessible for local buyers. In terms of monetary value, the decline in investor purchases is considerable, representing $36.4 billion worth of homes bought in the second quarter, a 42% decrease from the previous year. The median price of homes purchased by investors during this period remained at $470,000, mirroring figures from the previous year. When scrutinizing market share, investors acquired 15.6% of homes sold in the U.S. during the second quarter, marking a decline from the 19.7% recorded the previous year. This unequivocally indicates a substantial retreat from the robust investor activity observed during the pandemic.
I think the opportunities will be greater. Charlie, will you budge an inch on that or not?
There is so much money now in the hands of so many smart people, all trying to outsmart one another and outpromote one another, getting more money out of other people. It's a radically different world from the world we started in. I suppose it will have its opportunities, but it's also going to have some unpleasant episodes.
Now you might be contemplating who will bear the brunt of this storm. Will it be the big banks or the major investors? Actually, no. The most severe impact will be on the smaller entities, the individuals and organizations involved in real estate operations and lending. They'll grapple with the repercussions of lending at low rates, finding themselves burdened with personal guarantees and teetering on the edge of potential financial insolvency. Residential real estate prices have been steadily climbing over the past few years, but incomes have yet to catch up. This translates to housing becoming less affordable for the average person. Consequently, the demand for housing could start to decline. When demand decreases and prices continue to rise, a precarious bubble is poised to burst. The buildings may endure, but the owners might not. For the past 15 years, the real estate market has thrived on substantial amounts of cheap debt and low interest rates, fueled by a debt frenzy that has propelled real estate values to unprecedented heights. So how does this impact you as a homeowner or potential buyer? If you're currently in the market for a home, carefully consider your decision and conduct thorough due diligence. Purchasing a home during a bubble might entail paying more than it's actually worth. And if the bubble bursts, you could find yourself with a property worth less than what you paid for. If you have questions about this, drop a comment below as we delve further into how this upheaval will influence your decisions. Picture this. You bought a property for $1 million, put down 20%, and borrowed the rest from the bank when interest rates were low. It seemed smooth sailing, but as interest rates climb, the debt service coverage ratio, DSCR, is falling out of balance. A substantial portion of commercial real estate loans is on the verge of resetting at significantly higher interest rates. If the interest rate on a loan surged from 5% to 7.5%, the property might no longer generate sufficient income to cover the debt, rendering it financially unviable. And it's not just the rates. The trend of working from home, accelerated by digitization, is impacting the demand for office spaces. Reduced demand translates to falling rent prices, intensifying the storm's fury. Additionally, this might not be the optimal time to sell for property owners. While you could fetch a high price for your property, with the impending market crash, holding on to your property might prove to be a wiser financial decision in the long run.
The world is overwhelmingly short-term focused. And if you go to an investor relations call, they're all trying to figure out how to fill out a sheet to show the earnings for the year. And the management is interested in feeding them expectations that will slightly be beaten. I mean, that is a world that's made to order for anybody that's trying to think about what you do that should work over 5 or 10 or 20 years.
Buffett's secret lies in a disciplined long-term investment strategy, selecting robust companies and prioritizing steady, prolonged growth amid the tumult of new investment techniques and algorithms. He adheres to simplicity and substance, ignoring market noise that often induces panic in others. Warren Buffett comprehends the critical distinction between buying and investing in real estate. While he's no stranger to real estate investments, having invested in real estate investment trusts over the years, he acknowledges that managing real estate resembles running a business, requiring alignment with his expertise and focus. Real estate can be intricate, demanding scale and complexity to accumulate substantial wealth. Many individuals need to pay closer attention to the hands-on nature of being a landlord, as the misconception that it is a passive investment often leads to eventual exits. Conversely, passive real estate investing presents a different dynamic, allowing investors to enjoy the benefits of this lucrative asset class without being entangled in daily management. The FTSE Nareit All Equity REITs Index has exhibited impressive performance, consistently outpacing the S&P 500 in total returns for a significant portion of the past 2 decades. The figures speak for themselves, an average total annual return of 13.1% compared to 11.1% for the S&P 500. Warren Buffett, the investment maestro, recognizes his strengths and adheres to his realm of expertise. His commitment to a proven strategy is a testament to his unparalleled success. So what can we glean from Warren Buffett's warning about the real estate market? First and foremost, we should stay vigilant about market conditions and conduct thorough research before making significant investment decisions. Additionally, we should be mindful of how our decisions could impact our financial future and make intelligent choices that will benefit us in the long term. Warren Buffett, renowned for his staggering annual returns, has crafted golden rules that transcend equity investments and are applicable to various asset classes, including real estate. Here are 5 adapted principles inspired by Buffett that can guide your real estate investments. 1. Exercise caution with your money. Treat your investments as serious endeavors, not a gamble. Research, visit locations, and conduct thorough homework. Avoid investing solely based on recommendations. Be smart and informed in your decisions. 2. Embrace long-term investment. Think in terms of long-term gains rather than quick flips. Real estate is a marathon, not a sprint. Hold on to your investments and patiently reap the benefits over time. 3. Choose credible and stable builders. Don't gamble on builders. Look for a proven track record, investigate the people behind the project, and opt for builders known for customer satisfaction. Trustworthy builders can significantly impact the success of your investment. 4. Prioritize quality over price. It's better to invest in a wonderful property at a fair price than a mediocre property at a great price. Don't shy away from paying a bit more for quality. The long-term benefits often outweigh the initial cost. 5. Navigate market conditions. Stay informed about the market, seize opportunities, and negotiate effectively, especially in a buyer's market. Innovate your approach based on market dynamics, leveraging your research to make informed decisions. As Warren Buffett signals an impending storm, it's time to prepare, strategize, and position ourselves to weather it like seasoned investors. While uncertainties loom, remember that exceptional opportunities often arise amid chaos. Stay tuned for more in-depth analysis, expert opinions, and actionable tips on navigating these stormy waters. Like and subscribe for ongoing insights. Happy investing!